Hi there, and welcome to our annual or our June financial reporting update for not-for-profits and charities. My name's Anthony Whyte. I'm the national lead for BDO in the not-for-profit sector. Today we're going to be enlightened by Aletta, who heads up our Ifrs advisory team, our national leader in that space. So certainly looking forward to the next hour and what Aletta has to enlighten us with. Certainly last year was a year of big change for not-for-profits with the introduction of some new standards. This year there certainly is still some things to be thinking about, and I think bedding down some of those changes from last year. But looking forward, I think there are some big changes on the horizon too, and Aletta's going to allude to that. So Aletta, I'll hand over to you. Actually, just before I do, I'll just mention also too, we do have a pretty packed presentation today. So, but certainly feel free to add your questions to the question box as we go. In all honesty, I don't think we will have time to address those in this presentation. But we will come back to you on those questions post the presentation. So please feel free to put your questions in the question box. Thank you. Aletta, over to you.
Thank you very much, Anthony, for the introduction, and welcome everybody to the session. I might just add that you would have received the PowerPoint slides this morning. If not, you will receive the slides and the recording this afternoon. But on the right-hand side, there's also a section handouts. I've uploaded a PDF of the slides for you there. So if you want to make notes as we go along. Very important, no need to write anything down. You will get a copy afterwards at the very latest. So what are we looking at today? So we look at the new not-for-profit entity definition and guidance. It was on the table. We look at the future of special purpose financial statements in the not-for-profit space. We look at simplified disclosures by required by the new AASB 1060. We also talk about the recognition of income and or revenue. So we know we've got the new AASB 15 and the new AASB 1058. It's resulted in some discussions and some issues. So I just want to flag that again. I also want to talk about the ongoing impact of AASB 16 leases, actually the ongoing pain involved with this new AASB 16, and a brief update on Peppercorn Leases. And then Anthony and I will talk about latest developments that we've seen and that we're currently speaking to clients about. And finally, a quick introduction reminder around the application of payment times reporting scheme to not-for-profit entities. So that's at a high level what we'll be covering. And Anthony is correct. There's no new accounting standard for 30 June 2021, but some of the older ones or even some of the more recent ones are definitely throwing up some implementation problems, and therefore we want to go back to them and talk about them. However, we would like to start the session with, we believe, a really important issue for not-for-profit entities, a business issue, and that is how do you measure and report your impact? Now, I'm a board director at a not-for-profit organization, and I know last night when we had our board meeting, we were talking about an efficient, effective way to measure our impact and report that and communicate that. It's a competitive landscape as a not-for-profit to get funding, to get donor funding, and it's important that donors want to know that they make a difference. And so how do we measure and report that difference and the impact we have? So in BDO Australia, there are a number of people that look at various different tools on how to do this, but we thought today we'll showcase one of those. and that is we've asked Josh Geelan from who's an associate director at BDO in Hobart to share what he's been doing with clients. As an example, you are obviously welcome to reach out to Josh or me or Anthony or any of our other BDO partners who might have other alternatives available as well. So, Josh, before we look at the nice accounting nerd stuff, I'll give you an opportunity to showcase this, and I'll hand over to you.
Thanks, Aletta. Okay, so as Aletta said, we're grappling in Hobart with a problem, and it's a problem that's common across a lot of not-for-profits. So this is effectively a pilot project, and we wanted to tackle, with a simple solution where possible, a way to tackle the issue of, if I ask not-for-profits, what do you do? Why do you exist? Most of them tell me, okay, here's our mission, here's our vision, this is what we're here to achieve. If I then ask them, okay, what's your revenue? How many employees do you have? How many programs do you have? All the answers to those simple things are all quite well known, quite well measured and well reported. What's a lot harder is, what impact did you have? What impact did you have on client X's life? What impact did you have from a portfolio perspective in the community? What's your social license? How do you contribute to the government's portfolio or the investor's portfolio? And so what we've come up with as a pilot, and we've been running this since about June last year, is a simple way to measure and pull together those data sets. So what we have is a solution called ERIC, and that stands loosely for Enterprise, Reporting, Intelligence and Connectivity. Now effectively it pulls together a series of KPIs specific to the organisation and represents them in a way that makes sense around overall performance. And so I won't go into the full details of this, and it's important to note that this solution is one of many within the BDO suite of products. However, what it does do is effectively two things. At the board level, we track from a strategic perspective, client-centric and service delivery. So these are composite KPIs about how well or how much of an impact you are having at the client-centric level. And it's about 10 to 15 individual KPIs which feed into that as a generic solution, and also some clients will take that a step further and also make that customizable or specific to them. What the system does is look at your previous performance, your current performance, your target performance, and an average of the sector where other people in your sector who are applicable also participate. We also then look at service delivery. So from a strategic perspective, we look at, okay, what impact do you have? How best to measure that? And how efficient and how good are you at actually delivering that? And then we have the organisational capacities and capabilities. So we look at management and governance, which also includes risk. We look at people and culture and also financials. And so effectively we look at, okay, what capabilities do we have as an organisation? How can we best leverage those? And what's the most effective way to leverage those to achieve our client-centric outcomes? And there, what we're going to get into is performance reporting framework where we know where people have been, where they are, but importantly, where they would like to be. And the key to that is turning data or information into intelligence. So the so what do we do about that? So we have a score of 120.53 in service delivery. So what? What happens next? How can we get that better? Or even relative, is it a good or a bad score? And so without going to the details, the system then walks you through practical actionable insights to actually get that improved over time. So I won't go into that now, but if you are interested in reaching out and discussing any immediate needs you have, feel free to reach out to us in Hobart or any of the other BDO not-for-profit advisors as well. Thanks, Aletta.
Thank you very much, Josh, for that. I'm hoping I've got my screen back and then you can all see my slides. Beautiful. That worked well. It's these handovers that are always tricky. So thank you for that, Josh, and please reach out if we can help you. We know this is important to be able to tell your story. So if we look at the accounting aspects, that gets me excited. Let's look at the new potential not-for-profit entity definition. Now, this is a very short story because the AASB just last month decided that they're not going to continue with this project. The AASB wanted to replace the very a simple definition of a not-for-profit entity, as in the entity whose principal objective is not the generation of profit, with a new definition. I've got the new definition there. However, they've decided not to go ahead and focus on other more urgent work. I think the reason they've decided is they said they don't think there's significant issues with the current definition. They were worried about implementation guidance, worried about level of judgment, etc. Personally, I was somewhat disappointed by it because I know from an accounting perspective, whether you're a for-profit or not-for-profit entity is important to establish which accounting standards you should be applying. You know, if you receive a government grant as a for-profit, it's a very different standard to a for-profit that would look at AASB 1058 or 15. And also, we know for not-for-profit entities, there are OZ paragraphs available. So unfortunate that it's not be clarified, but I suppose we go and continue with the status quo. So at least we don't have a big change coming in that space. So that's the first part. So that project, no, not going ahead. The next thing that is indeed going ahead is the future of special purpose financial statements. Now this project, I can give you an update to the best of my knowledge. I think this is a project that will still play out over another 2-3 years. I can give you a general indication of where it's going. And we'll have to, you know, watch and see. The AASB have established a project advisory panel that's helping them with this, and I'm part of that panel. We meet fairly regularly, so I can share some of the insights that I've picked up there as well. So from a current state perspective, we know that not-for-profit entities and their reporting obligations, or to report and lodge with the ACNC, is driven by the thresholds and whether you are a small charity, a medium charity, or a large charity. I know we have similar requirements across associations, etc. So ultimately, why are you preparing financial statements? Why are you lodging financial statements? And what is that legislation or regulatory body categorize you as, small, medium, large, and what are their requirements on what you have to do? So if it's the ACNC, that's applicable. You know, small charities, your revenue less than 250, medium charities between the 250 and $1 million, and large charities revenue more than $1 million. And we know if you're a large charity, you must submit a financial report. It can be special purpose or general purpose, and it needs to be audited. The common theme here is across all of these criteria, whether it's small, medium, or large, is you've got a choice whether you want to prepare special purpose financial statements or general purpose financial statements. And that is driven by the, I would say, old definition of a reporting entity. And at the moment, this current state is continuing. So, you know, the ACNC is saying submitting special purpose financial statements, as a minimum, you have to do the following. So it's the basic standards around presentation of financials, cash flows, accounting policies, etc. So this is the current state. They've also made it very clear on the ACNC website that although there are recent amendments to the for-profit side of the world in AASB 2020-2 that removes reporting entity concept, that requires entities who lodge or requires for-profit entities who lodge financial statements with a regulator on a public record to prepare general purpose financial statements. This doesn't affect charities at this stage, and there's still an ongoing process to work this out. So it's important, however, that in order to get ready for this move to the future and the potential removal of special purpose financial statements, there is a new requirement in AASB 1054, Australian Additional Disclosures, that not-for-profit entities have to very clearly articulate which accounting standards they're complying with and which not. So very clearly what recognition and measurement you are complying with. So this is, the following additional disclosures are required. This is an extract from AASB 1058 and in particular paragraph 9A. So what they're saying here is make sure you clearly articulate what you're doing, because we know that you can continue with the status quo. Sometime in future, you might have to change, but as an interim measure, at least be very clear with what you're doing. And you can see there's a real emphasis here on how we account for entities that we control, or where we've got joint control or significant influence. It is also talking about, articulate if you're not doing deferred tax, articulate if you are not fair valuing as required by standard, make it very clear. So I think that is a takeaway to focus on this disclosure and particularly that consolidation aspect. So that's all current state. What I've seen in the for-profit world is they start by changing reporting thresholds, the regulators. They then start to add these disclosures to get transparency. And then right at the end, they come with the new rules. And I think for not-for-profits, we'll follow a similar path. So what could the future state look like for not-for-profit entities? Now, number one, we know already the ACNC have put out proposals to increase reporting thresholds for charities. Already we are seeing, and this is similar to what ASIC have done for profit before they removed special purpose financial statements. So again, it's a similar path. So now in future, the proposed annual revenue threshold for small and not-for-profits and charities, if it's less than 500,000, medium, between 500,000 and 3 million. So that's, 3 times. We've gone from a top threshold of 1 million to 3 million. It's quite a big change. And if you're in that medium category, obviously it's not a mandatory audit. It's you can have an audit or a review. And then for large charities or not-for-profits, it's if you've got, your annual revenue more than 3 million. And then we need audited financial statements. So these proposals came out. There was an opportunity to comment on these. And I think most not-for-profits would welcome these. The regulators want to make sure that we've got the bands, small, medium, and large, correct in the first instance, because if they come up with general purpose financial statements that potentially have to apply, let's say, to all large not-for-profits and charities, they want to make sure that large is defined correctly. So this is the first one to be aware of, that we've got potential changes to the thresholds, and we expect final announcements fairly soon, and we'll keep you informed through our newsletter. The other thing then is that the AASB is, in conjunction with that, the AASB is working on a financial reporting framework for not-for-profits in the private sector. So it's a proposal to remove a SAC1 and that reporting entity concept also for not-for-profits, similar to what they've done for-profit entity. The other thing that I think our clients and attendees today would be interested in is that there is a move or a development of a potential tier 3 and a tier 3 reporting requirements. So when we go from special purpose to general purpose would consist of a tier 1, a tier 2, and a tier 3. Now, currently, tier 1, you have to comply with all the accounting standards, all the disclosures. Tier 2 at the moment would be reduced disclosure requirements. That is also changing, or that's actually already changed. And then the possible introduction of a tier 3. So it's still general purpose financials. It's a tier 3 general purpose financial statements. And therefore, what would that look like? And at our project advisory panel, we are working through that standard by standard, what we think that could potentially look like in tier 3. So they want to make sure that we get the sizes right around the different requirements. They want to make sure that we've got 3 tiers in place, and then right at the end, there will be a removal of SAC1 and reporting entity concept. So you can see this is going to be a process that's going to take time. There will be more discussion papers, EDs, and I think important for the not-for-profit sector to actually be involved in those as we go along. Then if we look at, principles that's been used for developing those tier 3 reporting requirements, so they're trying to focus on what would users in tier 3 need, and weighing up the cost and the benefits of all the principles and the requirements that come into place. So they're looking at balances and transactions that's undertaken by not-for-profits in that second tier, if I say second tier, the medium size between 500,000 and 3 million of revenue. So, if you come up with these requirements, you have to say who will potentially apply tier 3, what size would they be, what would be their type of transactions and balances, and it's kind of aimed at that medium size threshold. Obviously, more than 3 million large not-for-profits will still be general purpose tier 1 or tier 2, and I know usually it's tier 2. So it's just this interaction between size thresholds, small, medium, large, and also when do you apply tier 1, tier 2, tier 3. So just a bit of background on that. So there's also, I've put in a slide on the things they're currently talking about. Now, nothing here is set in stone. It's all up for debate. We discuss it at the project advisory panel, then it goes to the AASB for discussion. So important to keep that in mind. The other thing that's important is in our tier 2, where currently, if you're in tier 2, so you prepare general purpose and you are tier 2, you would have used reduced disclosure requirements. And going forward, from 1 July this year, those reduced disclosure requirements are actually being replaced by AASB 1060, which we refer to as simplified disclosures. So for 30 June this year, you can still use reduced disclosures. However, from next year, you'll have to change. Now, what we're seeing again, and I think similar things will happen in the not-for-profit space, if you move from special purpose financials to general purpose, the question would be, which general purpose are you moving to? If you're moving to a tier 3 because you're in that medium size category, you'll have your special rules. If you are more than if your revenue is more than 3 million, so you're in the large category, you will go to general purpose tier 2, and arguably you'll therefore go to the simplified disclosures. So that will be your transition step. So just a little bit of information on current discussions, what we're talking about. The AASB is also looking at some of the requirements that are in place in tier 3 in New Zealand to see if we can learn from them, in particular to speed up the process, I would say. So simplified disclosures. This really links in. Yes,
Sorry.
Anthony.
I told you I'd interrupt at different times, so
No,
I apologise. Look, I think that piece that you were just talking about is really important and is going to be very significant for some not-for-profits. I will just mention before I talk about why it will be so significant is just in relation to associations. Unfortunately, across the various states and territories in Australia, they're not, the legislation in each state and territory around the financial reporting requirements for associations isn't yet harmonised for all of those with the ACNC requirements. So Victoria, I think, is leading the pack, and I know we've got quite a few Victorian people that have dialed into this webinar. The legislation does basically say, well, the financial reporting requirements of the ACNC Act, if you meet those, then you meet the association requirements, and so you only need to prepare accounts under the ACNC Act and lodge them with the ACNC. In Queensland, and again, we've got a lot of Queensland people that have dialed into this, they did earmark over a year ago that they were going to amend the Associations Act here, so that if you met the financial reporting requirements of the ACNC Act, then you met the requirements for the Associations Act. They were telling us back then that that would come through by 30 June 21. That hasn't happened yet. So anyone that their organisation is an association, you've still got to comply with both the Associations Act and the ACNC Act. And in Queensland, the reporting thresholds are a lot less. So if you're over 20,000 in turnover assets, you have to have at least a review or an audit for an association. But anyway, hopefully we'll get there at some point soon. Probably just briefly to mention around what you were talking about, Letta, and just to highlight how significant that is going to be for some not-for-profits. There are certainly some not-for-profits out there that have been around for a very long time and that still really only report at a head office, state head office level, even though there's lots of activity happening throughout the state that prepare special purpose accounts. If and when they get to the point of preparing consolidated accounts, that is going to be a big jump for them. Yeah, just wanted to highlight that is going to be a significant impact.
Thank you very much, Anthony, and please feel free to interrupt at any stage. I really appreciate your practical knowledge in this space. The other thing that's interesting, those of you who love the accounting standards like I do, there was an old standard AASB 1, which we applied at the big end of town in Australia in 2005. It's around the first time adoption of international financial reporting standards. Now that standard is making a comeback big time. Because when for-profits or not-for-profits go from special purpose to general purpose, you have to apply AASB 1 because it's the first time you are applying Australian accounting standards. So, you know, if you're looking for extra reading on your holidays, AASB 1 is making a comeback. And I think it's taking on Jeffrey Archer and all his latest bestsellers. So that's just from a bit of extra reading. To look at simplified disclosures required by the new AASB 1060, as I said, for 30 June 2021, this is not mandatory applicable yet. It will be applicable from 1 July, but we wanted to flag that it's coming. There are also transitional provisions available, so if you adopt this early, you get some shortcuts that might help you. So we've got quite a number of clients that are already saying, we don't like RDR, we want to get rid of RDR, let's go to the new regime as soon as possible. So obviously you could do that. Now, if you're currently doing special purpose financial statements, this is not relevant for you. This only applies if you're doing general purpose financial statements. I've put in a few slides on what is new. I think the key thing in this new AASB 1060 is there's a focus on disclosures around related parties. Additional requirements around financial instruments and not and also tax. And there's also an interesting option, which is that second last triangle bullet point. And that is an option not to present a statement of changes in equity under certain circumstances. So, as you know, a number of years ago, we've introduced the statement of changes in equity, but there's this option not to present it that I think a lot of not-for-profits might find useful. We know not-for-profits usually don't have a lot of equity, so it is a little bit of a 0-0 statement anyway. So you could get rid of that. And then and there are some additional disclosures that's not currently required by RDR, but it's a little bit of a shuffling of the deck chairs. The disclosure requirements in the new AASB 1060 has actually been based on the disclosures of the Ifrs for SMEs. So in Australia, we don't like the recognition and measurement of the Ifrs for SMEs because we believe in transaction and sector neutrality. However, they thought, let's look at the disclosures in the Ifrs for SMEs because it's focused on SMEs. Maybe those types of disclosures would be relevant here as well. So that's really where they've informed some of their decision making. The other thing that I wanted to flag is, I know disclosures can be a tricky thing and there's quite a lot of work involved. So we've developed at BDO a disclosures management tool, and you can contact me about this to talk about this a bit further. And really what we've tried to do here is come up with a collaboration tool. So, this new AASB 1060 has 775 disclosure requirements. So we ask clients to, if they use this tool, to answer a number of tailoring questions, and then the tool would give you the disclosure requirements fit for purpose for your business. You can then look at all those particular disclosure requirements, put in why you've complied with it or not, it's not material, etc., and then invite your auditor to have a look at this tool and look at all your responses, and the auditor can say, yes, we agree with your tailoring questions, we agree with your assessment whether it's material or not. So it's a collaboration tool between the client and the auditor on the one platform in the cloud. So it's just another way that we think technology can help around disclosures. The next thing I think is really important, and this is the recognition of income and or revenue. Now, you would be familiar with this decision tree. Now, these two standards were first implemented last year, so 30 June 2020, together with the new AASB 16. Now, during the year, we found some interesting conversations. Actually, just yesterday, I talked to a really large not-for-profit client, and they said they found that last year it was a real big project to get the recognition and measurement under control. They are revisiting that this year. They've actually asked me to help them with some position papers around AASB 1058 and 15. They want to make sure they've got it right. It's the second year. It's a time to look at this a bit more calmly. But then importantly, they said, you know what, we think last year we didn't get the disclosure side right. AASB 1058 still have particular disclosures around government grants, etc. AASB 15 different disclosures around performance obligations, contract assets, contract liabilities, and they acknowledge. We think we maybe focus so much on recognition and measurement that we fumbled over the correct disclosures, and I think that would be a common theme. And it's interesting, in our accounting news that will be issued next week, we've already written an article on maybe it's time to look at disclosures, and we have an article this month and another one next month looking at the specific disclosure requirements for not-for-profits when they apply AASB 1058 and AASB 15. The other thing that clients are telling us is this is, again, not a standard, or these two standards are not standards that you implement and then you just move on. From now on, every contract with a customer, every grant agreement, any funding, each and every funding agreement will have to be assessed, basically using this decision tree, because a not-for-profit cannot decide to only apply 1058 or only 15. Every individual contract we need to assess. So we have to ask, are the funds received for the purpose of acquiring or constructing a non-financial asset? If it is, you've got no choice. You have to apply paragraphs 15 to 17 of AASB 1058, where you recognize the income as you spend the money on the construction or the acquisition of your non-financial asset. If the funds were not related to acquisition or construction of those non-financial assets, the next yellow box, does the transaction occur in a contract with a customer that created enforceable rights and obligations? Now, usually the easiest way to get to enforceability is if you have to return the money, if you don't spend it on the appropriate items, or if there's a big penalty involved. But there's legal enforceability, a legal question, therefore. If there's no legal enforceability or enforceable rights and obligations, you're outside the scope of AASB 15. Absolutely, you have to look at AASB 1058. However, if you've got legal enforceability, and then the big one, do the contracts include sufficiently specific performance obligations, you could apply AASB 15. Again, if not, you're stuck with AASB 1058. Now, I know not-for-profits would love to get to a position where they could apply AASB 15. And the reason is, if you apply AASB 15, you've got a fighting chance to potentially recognize your revenue over time. So it's not an automatic, but at least you have an assessment to make in step 5 of AASB 15. I think what is interesting here is that often that yellow block number 2 and 3 are closely connected, in that you've got enforceability, and potentially you return the funds unless you spend it on sufficiently specific performance obligations. So often the two are quite connected. And I think that is something we've seen in practice. So it's not just here's the money, you decide how you spend it. Here's the money, you're only allowed to spend it on A, B, and C. And A, B, and C is actually performance obligations. And therefore, you can apply AASB 15. Now, so that's a bit of an overview. I would have imagined every not-for-profit have this decision tree, or the words in this decision tree, as the introduction to their accounting policy around AASB 1050 or 1058 or AASB 15. Now, sufficiently specific performance obligations creates nightmares. So I'll try and discuss this. I think there's a spectrum here. We could receive funding that are directed at activities, specific things we have to do. Sometimes we receive funding that have to lead to certain outputs. And sometimes it's just funding in order to pursue certain outcomes. So if we look at them a little bit more closely, activities is a bit of a problem, because if you receive funding to spend on sufficiently specific activities, that doesn't mean you've got sufficiently specific performance obligations. The concept of performance obligations actually means that there is a transfer of a good or a service external to the organization. So we give you money, and you have to use this money to transfer a good to a customer or provide a service to a customer. We're not giving you the money to spend it on internal activities and tell you which internal activities you have to spend it on. That's not sufficient. So internal activities is not sufficient. We give you funding to appoint a staff member. That's not sufficiently specific, because there's no performance obligation. There's no transfer of a good or a service. So please be careful for activities. Often clients gives us list of activities. We have to prepare a budget. We have to do a lot of internal things. That's not a performance obligation. It's not a sufficiently specific performance obligation. It's just a sufficiently specific activity. Outputs is really where we want to be. And that is there are external outputs. We transfer goods, we provide services to customers or to people on behalf of customers. And that would be a sufficiently specific performance obligation, because in that instance, we can measure to what extent have we transferred the goods, to what extent have we provided the services. So we want to try and get to outputs. Now, outcomes on the right-hand side, I think is where it gets a bit grey. If you just receive money to achieve your vision or your goals or certain high-level outcomes, that's not a sufficiently specific performance obligation. However, I would say it's somewhat grey, because sometimes in order to achieve these outcomes, I would say maybe embedded or implied in it are certain outputs. Maybe it could be I want to increase the number of children participating in cricket. I love cricket, so so that's an outcome we want to achieve, and maybe our outputs linked to that could be running coaching clinics or spending money on grassroots. Or I know my son used to play Milo cricket here in Melbourne. So outcomes, it's difficult. Usually it's not a sufficiently specific thing. But I suppose we could explore it a little bit, and it's grayer there. The easiest one absolutely would be around outputs. Because if we've got outputs, sufficiently specific outputs, performance obligations, and there's legal enforceability, we could get to AASB 15. If not, and we apply a AASB 1058, it usually means that you recognize the income on day one when you receive it, usually. And I'll say usually because you have to consider whether when you receive the cash, there's actually an obligation. So, is there a financial liability under IFRS 9? And that could be in a situation where you receive money, but you are obliged to pass that money on. So maybe you receive money and you have to pass 90% of it on to charities or not-for-profits in a particular area, and you keep 10% to cover your admin expenses. So in that situation, potentially when you receive the money, debit the cash, you don't credit income. It's not your income. You credit a financial liability because you've got an obligation to pass it on to other parties. You're more just a conduit. So that's another thing to also consider. So many little things to consider. So I think this decision tree is really important, and to step through all the aspects. If you apply AASB 15, we know it's all about you recognize the revenue as you perform. If you apply AASB 15, step 5 would be the interesting one, because you have to make sure, when do we perform, when do we transfer the goods, when do we provide the service, and then potentially you can recognize the revenue over time. Not always, but at least you've got a chance. Anthony, was there something you wanted to add on the revenue income?
There is, absolutely. And I'll be really quick here because I'm conscious we've only got 15 minutes left and a bit of territory to cover. So I'll be really quick. Just on that whole point around the revenue and the performance obligations from an audit point of view, what we love to see is when the accountant is talking to the people that are administering the programs, administering the grants, and that they're understanding in their discussions with those people, what are the deliverables under it. Obviously, we like them that they're looking at the funding agreements too, but they're talking to those people, what are the deliverables, how are they measuring those deliverables, what's being reported in the performance reports. So the auditors will be asking to see the performance reports, just not financial acquittals around those grants. So that I think is really important at a practical level. I will also just mention too, Aletta's completely right around the disclosure. I think that will be a bit of a focus this time, making sure we're ticking the boxes in the standards on that. What I will just note there, obviously the financial report is an important document in telling the story for a not-for-profit organisation, and we should never lose sight of that. So obviously the disclosures and how we present things are very important in that. In my experience, you can certainly combine the two. Sometimes you do need to think outside of the box a bit, but how do you meet that requirement of minimum disclosure requirements under the standards, plus also tell your story and not let key aspects get lost. And certainly when you get to your revenue note and expenses note, that's where you can put a bit of thought into it and make sure you're ticking both boxes. But anyway, that was all I wanted to say there. Thanks, Aletta.
Thank you very much, Anthony. I suppose AASB 16 around leases, if you're currently doing special purpose, I think many entities have decided, we're not going to comply with AASB 16. If you are complying with the recognition and measurement of AASB 16, you would have realized that this can be a painful experience. So I'm not going to work through all the slides. I just want to focus in particular on some of the problem areas that we've identified over the journey. The biggest or the single biggest issue is lease term. And the issue around lease term is that many entities have focused on the legal lease term and have not considered the IFRIC agenda decision around lease term. And what they're saying is lease term, basically, you look at the substance and not the legal form. So even if you've got a month-to-month lease, even if you've got a lease that are now in holdover, you have to think, is there an economic reason that you will stay in this property? And if so, that should factor into your assessment of the lease term. So it could be that you are leasing a property from a related party on a month-to-month basis, meaning both parties can cancel at the end of every month. However, we know for economic reasons, you'll always continue with the lease. There's not another property appropriate in size or fit out in the town. You've got a really good deal, you've got certain furniture and fit out, and therefore lease term should take that into consideration. So I really want to point that out. Please be very careful around lease term. So you'll first look at the period that nobody can cancel. So if I've got a 5-year lease and a 5-year option to extend, but I can also terminate after 2 years, it would mean my period 1, nobody can walk away, is only 2 years. First 2 years, nobody can walk away. Then we get that termination option that happens at the end of year 2. So if both the lessor and the lessee can walk away at the end of year 2 or the end of the month, as another alternative, we have to consider, is there an economic reason that the lessee or the lessor will walk away or not? If there's an economic penalty that either would suffer, we would say then they won't do it. I mean, it doesn't make sense to do. And then we get to extension options. So potentially it's 2 years. We're not going to potentially exercise that termination option at the end of year 2 because we've invested money in improvements. So it will at least be 5 years. And then we think, do we think it's reasonably certain we'll use that extension option? So you have to work through the non-cancelable period, consider termination options, consider economic incentives, economic penalties, not just legal penalties, and consider whether you're reasonably certain to stay there. That's a big issue. Now, AASB 16 or IFRS 16 is not a set and forget. It's ongoing pain. There's new leases, there's terminations, there's reassessments, there's modifications, there's COVID-19 rent concessions. The standard has twice been changed over the last 14 months around COVID concessions. So this diagram, I think, is a piece of gold where we outline the different types of changes. Do you expect an impact of this change in P&L? Do you have to update your incremental borrowing rate or not? Or do you just adjust your liability and your asset? So our team who does outsourced lease accounting use this every day, the whole day. Really good overview summary of the standard around remeasurements. COVID-19 concessions. We've got a publication that talks about the impact of these COVID-19 rent concessions. You've got a practical expedient, you've got a choice to make. We can help you to model the choices, and you'll see in this diagram you can use this practical expedient, or you'll have this choice available if you meet 4 criteria. And that third criteria originally said if it changes your lease payments that were due before 30 June 2021, and I've put in yellow, it's recently been changed if it impacts your lease payments before 30 June 2022. So if you've previously decided to use this practical expedient, but you didn't qualify for the practical expedient, you can now retrospectively apply it. Fairly complex rules on how to do it, so please reach out and we can help you with that. And the other thing is impairment testing of these right-of-use assets. We've got a beautiful new global publication on how to do impairment testing of assets, and in particular these right-of-use assets. At this stage, I would say bringing these right-of-use assets on your balance sheet should not in itself trigger an impairment loss. However, it does change the way you actually conduct the whole test. Unfortunately, when right-of-use assets came on balance sheet last year, it happened at the same time as COVID, so we often saw impairments, but that was not as a result of AASB 16. It was linked to COVID-19 implications. And then the one question that I always get asked is around Peppercorn Leases. Now, the AASB is keeping that relief that not-for-profit entities don't have to measure right-of-use assets linked to Peppercorn Leases at fair value as yet. I think they're still waiting for the project around how do we value these to be finalized, and also to reach a final position on who needs to apply, who needs to prepare financials, those size thresholds we talked about, and also will AASB 16 be incorporated into Tier 3? So maybe AASB 16 will not be captured in Tier 3. So that's still up for debate. So they're saying, let's just wait for all of that before we have another look at that. So that temporary option is still available. I want to talk about some latest developments in the 7 minutes we've got left. One is that the ACNC have a best practice guide out on financial report disclosures. I just wanted to link it to that. I think there's a very important thing, and that's that second bullet point, triangle bullet point, around that they recommend 3 disclosures: information about sources of government revenue, economic dependency on government revenue, and also funding that you've received from government but you've not yet recognized as revenue. So that's a recommendation. So it's again those disclosures about government funding. That's really important, and I've put in a link to that document for you. The other thing that's a big issue really for for-profits and not-for-profits at the moment is around during COVID-19, if you've spent a lot of money on a SaaS implementation or customization costs. So this is software as a service arrangements where you access your software through the cloud. You know, I know Australian entities to date would have capitalized these customization implementation cost without really much thought about it. However, the IFRIC just 2-3 weeks ago came out with a decision to say that these SaaS implementation configuration costs, we have to look carefully at it. I think most instances it will actually be expensed. So there's a final decision that you could look at. And I've tried to summarize it in this diagram, and that says, you know, what's happening here is if you've got software that you own and you access it through the cloud, so it's in Microsoft Azure, and you spend configuration or customization cost on those assets, you know, that software is an intangible asset in the first place, and you now customize it, fair enough, you control it. That's okay to capitalize. However, if you are accessing software through the cloud, you don't control it, you just access it, and you start to customize it or configure it. You don't control the software, therefore you don't control the customization and the configuration, and therefore it should not be capitalized, it should be expensed. So I know the regulator indicated they would like us to fix this by 30 June. It's a big job. We have to go back to all the cost we've capitalized over the last 3-4 years and reassess whether it should be capitalized or expensed. So I just wanted to put that on the table. Anthony, I'll hand over to you to talk about portable long service leave.
Excellent, no worries. And I will just put an exclamation mark behind that last point you made, Aletta. That is going to be a big issue. Out of all the surveys that we've conducted over the past few years in the not-for-profit space, updating systems is a big area of focus. And so there's a lot of money being spent and has been spent in that space. And this, yeah, I have to admit personally, I'm not getting it, and I had an argument with Clark, the technical person in the Brisbane office yesterday, but we don't have time to talk about that. So yes, portable long service leave. Look, I will be really quick on this. So the key thing I want to talk about is just the accounting. So we have done a few webinars on this over the past few months. Big issue is who's in and who's out. Certainly watch the webinars for some really good guidance around that. And there also is a webinar on the accounting. The only thing I will say about it is once the portable long service leave kicks in, so for Queensland it was 1 January this year. For Victoria, I think it's been there for 1 or 2 years now, and ACT is the other, is the territory that has this in place as well. You don't stop doing your provision accounting calculations for staff. So you will have your spreadsheet set up where you've got your staff members, you're calculating out the long service leave entitlement, you're applying probabilities and discount factors to it. Don't stop doing those. What you do need to factor into those calculations now is what you expect to receive back from the Portable Long Service Leave Authority. So in Queensland, it's Q leave, when that person takes long service leave. Now that will bring the provision down quite a bit in Queensland from 1 January onwards, but there will be elements that the long service leave, Portable Long Service Leave Authority won't cover. And so it will still grow that provision as well. Watch the last webinar we did on that a few weeks ago. There's more information in that, and certainly please reach out to us if you have any questions.
Thank you very much, Anthony, for talking through that. So we just wanted to say, please make sure you keep those long service leave provisions in your balance sheet, right? I think that's a key message. The other thing is, I'm just double checking, what have I done? Did I go too fast for myself? No, I've got it right. The AASB issue not-for-profit frequently asked questions, and BDO has actually worked with them on a lot of those. So if you, I would recommend that you go and look at those AASB frequently asked questions. They talk about accounting for research grants. They've got not-for-profit schools, how they should recognise for, the school fees, etc. There's also a FAQ on accounting for concessionary loans, etc. So that's a really handy resource that they've put out. It's by BDO and the AASB staff. JobKeeper, I'm not going to discuss again. I'll just put it in. I think this was more an issue last year, maybe still in Victoria, a bit of an issue. It's accounted for under AASB 1058. More around the timing. I don't think we'll have a timing issue around 30 June this year because we no longer are entitled to JobKeeper, now more job seeker. But, just around, remember from a presentation perspective, we don't have a choice to offset it against salary or not, because it's within AASB 1058. That offsetting is in the for-profit standard, and it's other income in our profit and loss. We also have a publication around COVID-19 and the impact on financial reporting. I just wanted to remind you of that. There's still some ongoing impacts. And then sustainability reporting is a real big thing that's coming from global to Australia in for-profit world, but also in not-for-profit world. And a little bit back to what Josh talked about right at the start around your impact, your social license to operate. So there's just a very interesting publication. This one is particularly around climate-related matters, but in every month's newsletter, we include some other aspects around diversity targets, modern slavery, and a lot of those things do impact not-for-profits in particular. So you can look for articles in our accounting news. I've also included a section on payment times reporting scheme, and I really just wanted to say that this also applies to certain not-for-profit entities. If you are registered with the ACNC, it doesn't apply. But there are a lot of not-for-profits that are maybe registered with ASIC, not the ACNC, and therefore they will be caught by this new regime. So I just wanted to put it on your agenda. Please don't think that this is not applicable. And it really is a great initiative to make sure that the big end of town are transparent on how they deal with small businesses and the timely way they pay them. So I think it's a good initiative. If you're a large not-for-profit, you might be caught by this. So please just double check. And I include a link to a publication prepared by some of our colleagues nationally, and I think driven out of financial management consulting in Brisbane, in particular, at Tom Hogben. If you're looking for any assistance, we can help you to get audit ready. Please reach out to any of your BDO contacts, Anthony or I, or any of our not-for-profit contacts. If you are starting to think about a transition to general purpose financials, indeed, we can help with that as well. We're also running a series of 20 virtual workshops where we're looking at 20 key accounting standards to kind of, explore all these general purpose financials and what they mean. Tomorrow, we're already running, I think, the 9th or the 8th or the 9th one on share-based payments, which is not for not-for-profits, but if you're interested in any of the others. If you're looking for help around leases, please reach out and we can help you to deal with that. And then I've put in a reminder of all our IFRS advisory leaders across the country. But please feel free to reach out any of your BDO contact people, and definitely we'll find a way to assist you in whichever way is most appropriate. So I thought I'll put in a nice photo of all our little team members across Australia. There you can see Clark from Brisbane. Anthony, please don't have arguments with Clark. Ashley is in Perth. Kevin is in Sydney. Lynn is in Adelaide. So please feel free to reach out to us. And we also have a not-for-profit industry group, and we've got a page on the website with all their contact details, and Anthony is the leader there. So any questions, please feel free to put in the question box. We've run out of time, Anthony, but we've pulled it together, I think, at the end.
You've done well, Aletta. I've done well. But we do the audit and work, a variety of work for a lot of not-for-profits. So we had too many photos to fit on that last slide there. So that's my reasoning for that. But no, thank you very much, Aletta. I know there's a lot of knowledge in your head, and you do explain it very well and in great detail. So it is hard to certainly keep it within the hour, but we're very fortunate to have you share that with us. So thank you very much. And please, like I said before, if you do have any questions, please add them to the question box, and we will come back to you. Someone from an office in your state will come back to you on those.
Yeah. Anthony, thank you very much. It is our first joint webinar. I hope it's the first of many. I hope you have a good day. I see beautiful blue skies behind you in Brisbane, as always. I'm freezing here, as you can see, in Melbourne, but let's do this again. It was fun.
Excellent. Thanks, Aletta.
Thank you. Thank you, everybody.
Bye.